How many millionaires do you know that have become wealthy by investing in savings accounts? I rest my case. There's hardly any, because if you invest in a savings account, you're going to get a 1 to 2% return, 3 if you're lucky, and the stock market's average return is 10%. So with this video, I'm going to teach you how to invest in the stock market for beginners. We're going to start right from the very beginning, exactly the step-by-steps that you need to take in order to build up a portfolio that's going to build you long-term wealth, a lot more than the tiny 1 to 2% returns that you're going to get on your savings account, which is absolutely worthless. So this video is made specifically for beginner investors, but to be honest, it does not matter what level of investor you consider yourself. I think you'll derive a ton of value from this video if you're interested in the stock market. So I want to cover 4 main points in this video. The first is how to choose a stockbroker. That's what you use to buy and sell shares. The second is how to screen all of your stocks from the bad ones to the good ones. There's over 4,000 stocks in the stock market. How do we screen out those stocks to just a few stocks? Then I will teach you the 4 rules that you need to know before picking out that individual stock and adding it to your portfolio. And the 4th thing I want to do is teach you how to build a diversified portfolio. So those are the 4 main points that we're going to cover in this video. I'm going to put the timestamps in the description. I don't care if you skip to a different section. I'm guessing most of you know how to find a stockbroker and all of that, so feel free to skip to whatever section that you need. Subscribe to Cooper Academy. I post heaps of videos on the stock market. Drop a like, and guys, let's just get straight to it.
Guys, the very first thing you need to do is choose a brokerage firm. Essentially what a brokerage firm will do is provide a platform for you to buy and sell shares. So you first have to choose the broker, or how else are you going to own a share? Right, so I'm just going to give you an example of a couple of quality brokerage firms out there. These brokerage firms are for people who live in the USA. Since most of my audience do live in the USA, I will however include one international stock broker. I'm going to start this off with a very simple one, which a lot of investors use. It's very cheap. It's called Robinhood. So the best thing about Robinhood is that you can invest in stocks, ETFs, options, cryptocurrencies, all commission free. So you don't have to pay anything to make a trade or own a share. And you can do this right from your phone or desktop. So you can buy all 4 of these asset classes with 0 commission. It's a great broker to start with, especially for the beginner investor. And again, both on your phone and laptop. It's pretty simple to use, pretty simple to figure out. There are of course a couple of negatives to Robinhood, including no fractional shares, no shares listed outside of the New York Stock Exchange and Nasdaq, and no bonds of any sort. Next, a broker that you can use to diversify your stocks and invest more internationally is Fidelity Investments, which provides its clients access to stock exchanges in 25 different countries. Fidelity has over 70 million customer accounts and charges you $4.95 for online equity trades. And I'm going to finish off this brokerage section with a broker for a lot of you international investors out there and people from the US as well. This broker is called Interactive Brokers. They trade in all of these countries here. It's a lot. They give you low commission rates, the chance to invest in 30 different countries, and they provide a host of investment products.
And to be honest, I don't want to get too in-depth into all the different stockbrokers that there are. They'll just take up too much time. There are other YouTubers who have covered this in more depth in different videos. So I'll link that into the description as well. So go check it out if you want to go more in-depth into the different stockbrokers. Let's get on to something that's very important though.
So now that you've chosen a stockbroker, you've got to choose some stocks to buy. But there are over 4,000 actively traded stocks in the USA and 15,000 stocks traded over the counter or outside of the USA. So the question becomes, how do we screen out the stocks to buy from the massive list of stocks that are out there? I'm going to give you 2 main ways that you can do this. The first way is using a stock screener. So one stock screener that you can use is Yahoo Finance. Just type in Yahoo Finance stock screener. And now I'm going to teach you arguably the most important things that you want to screen for in a stock. And I learned this from a book which is called A Little Book That Beats the Market, and essentially it has 2 main points to it of what you need to look for in a stock. The first thing you need to look for in a stock is a low PE ratio. This basically means you're paying a low price compared to the earnings of the business, a low price compared to what the business is bringing in. So let's put that into our screener. But you can't just have a low price. You must invest in a good business. And this book's definition of a good business is one that has a high return on equity. So let's put that into our screener. I'm going to put a return on equity of 15%, which is what the investor Phil Town recommends. So we click find stocks and we get a whole list of stocks that fit our screen. That is one way to help narrow down stock picks. The second way to narrow down stock picks is by looking what gurus and investing mentors are buying. Now, just to be clear here, I'm not saying go blindly buy a stock that an investing guru is buying, but I am saying it's a great place to start by looking at what these types of people are investing in. And then, of course, do your own research on the stock and make your own decision. So, now that we've found a list of stocks to choose from, we need to then do our own research. So what are the things that we need to do before we buy a stock? I'm going to teach you 4 things to tick off before you hit that buy sign.
So the 4 rules that I'm going to teach you is what I learned from Warren Buffett and Charlie Munger. These guys are the best investors in the world, and they always go over these 4 key rules before they invest in a stock. And don't worry guys, the one thing that pretty much everyone loves about Warren Buffett is that he likes to make things very simple. Even if you're a beginner investor, you should be able to understand these 4 rules to investing in a stock. So it's not too complicated. Apart from the 4th step, that's probably the hardest one of the lot. But first I want to make it crystal clear what a stock is. A stock is a small portion of a big business. So when you buy a stock, think of it as if you are buying an entire company. You're going to be getting the revenue that the company brings in. You're going to be owning the assets. So what do you want to look for in a company that you buy? The first thing that you need to be able to do before you buy a company is this.
So let's just say I take you, a new investor, for a walk down the street in town where all the businesses are. I say you can buy this business, and here, all of these different businesses are for sale at different prices. You're not just going to randomly go and pick a business to buy that you kind of like because it sounds like a good business and then, go and buy it. The key here is you want to buy a business that you understand. This way you know how it's making money, you know if it's a good business or not, and you know if it's a good deal or not. So Buffett's first rule is to understand the business, and this is actually why Buffett buys quite simple companies in the end. Buffett owns Coca-Cola stock. That's a very simple business model. He owns See's Candy. This business, very simply, it sells candy. Not hard to understand. Kraft Heinz, the food company. Quite basic. So if you're a new investor, you may want to start with businesses similar to Buffett. The likes of Coke, Pepsi, McDonald's. Just easy stocks to understand. And then you could start to branch out a bit. Buffett also owns a large stake in Apple stock, which is a little bit more complicated than Coke and See's Candy, but it is, possible to understand, even for the beginner. They bring in most of the revenue through iPhone sales. They also sell iPads and MacBooks. They generate money through services segment like iTunes. So my recommendations for beginners is to start with easy businesses that they understand and then to branch out into more complicated ones. At the end of the day, it's the managers that runs the business. You're the owner of the business. That's what a stockholder is. The managers manage your business. So you want managers, well, first of all, that you can trust. Someone that has integrity. You do not want a dishonest manager running your business. What you want to do is first listen to the interviews that they have done before. Listen to what they say at shareholders meetings. And then make up your mind if they are at least trustworthy. Next, you want to see if they have any talent. Are they passionate about their business? Are they the type of person you want running your business? That's the question you need answered. Now, a good manager, and Warren Buffett has talked about this a lot before, will run the business as if he is running his own private business. So he's not going to focus on going out and doing all of these interviews, speaking engagements, trying to sell people the stock. No, his time will be spent trying to improve the actual fundamentals of the business, the bottom line, the cash flow, the employee employees, all of that. An example of a great manager is the man himself, Warren Buffett. He really only does, a couple of interviews a year from people that he knows, and of course he does the once a year shareholders meetings for shareholders. Most of his time though is spent in his office, reading, learning, and trying to improve the fundamentals of his business. His business is Berkshire Hathaway, which is an investment holding company. So Buffett spends pretty much all of his time trying to make better investments. He's the type of manager you want running your business. By the way, guys, if you are enjoying this video so far and you found it useful, please drop a like on the video. It really helps my content. Thanks, and let's move to the next step. The next thing you need to look for in a stock, in a company, is one with a durable competitive advantage. Warren Buffett talks about this a lot. You do not want to just own any ordinary business. You want the companies that are the best, the ones that have an advantage over the competitors. Let me give you an example of a durable competitive advantage using stocks owned by Warren Buffett. One stock or company that Buffett owns is Apple, which Buffett owns 25.78% of his portfolio in. This is a great example of a durable competitive advantage. Apple is no ordinary company. It's known for delivering the best of the best products and services. For example, the iPhone and the iTunes Store. Customers are willing to pay way more for an iPhone than for an Android because they know they're getting a better quality product. And it's also going to make them look, cooler and more reputable in front of their friends. This gives Apple an advantage over competitors because they're going to get more revenue from each phone that they sell. Another example of a durable competitive advantage is the stock Coca-Cola, which Warren Buffett has 8.35% of his portfolio in. Now, Coke is no ordinary drink. It's got that specific flavor, specific recipe to it that makes customers keep going back for more. There's a reason why it is the most popular drink in the world and has been so far for a number of years. It's all around Coke's brand name and the taste of product. So because people love the product and because Coke has such a good brand name, they can sell a lot more drinks than their competitors, and in the end they become so wealthy they've actually bought most of their competitors out. And Coke's brand name and product is durable. It's going to last for a long period of time. You're not just going to lose your brand name like that or lose the taste of your product. And that's what Buffett saw in Coke stock, that competitive advantage, and that is why he bought so much Coke stock back in the day. So rule 3 in choosing a stock is choose one with a durable competitive advantage. The fourth and final rule to Buffett's way of investing is pay a price that makes sense. I mean, everyone knows a Ferrari is an amazing car, but the question is Ferrari worth that $300,000 price tag? So once you've found a great business that you understand, one with great managers and a competitive advantage to it, you need to work out if the price tag is worth it. So to do this, you need to find the intrinsic value of the company, and I'm not going to go too in depth into this method today, but I will link some videos in the description that goes more in depth into how to value a company and how to know if the price makes sense. But for this video, I'll give you one cheeky quick way to figure out the value of a stock, and to do this, we're going to use Apple as an example, and with this method, we're going to use price and earnings. So Apple currently has earnings of pretty much $12 per share. So that's how much the company is bringing in, its profit per year. So how much should we pay for this company that is bringing in $12 per year? Well, if you wanted a 10% return, you would pay $120 because 12 divided by 120 is 10%. So you'll get a 10% return on your investment per year. So the current price of Apple is $158. So what return can we expect with this stock? Well, 12 divided by 158 is a 7.6% return. So with Apple stock, we can expect a 7.6% return on our investments in the long term if Apple can sustain their revenue. You will get an even higher return if Apple continues to grow their revenue. Now remember, this is in the long term. Anything can happen with the stock market in the short term. Buffett says the stock market is a voting machine in the short term. So you got a bunch of investors, a lot of them who don't understand the business, who vote on the price of the stock. But in the long term, the market is a weighing machine and it will weigh the actual value of the business. So follow those 4 rules carefully like Buffett and you can see some decent returns on your investment. I try to follow these rules when I make my investments and you can see my model portfolio if you want, and join my membership group called the Investing Academy, $19 per month, and of course the link is in the description. But let's move forward.
Okay, so now you know how to find a good stockbroker, you know how to screen out the good stocks from the bad stocks, and you know how to choose a stock. The next logical question that comes to mind is, how do we build up a well-diversified portfolio?
So I just wanted to say right off the bat that this is by no means the perfectly diversified model portfolio allocation. This is just a template that you guys can use. So first, let's start off with gold. So Ray Dalio, one of the greatest investors of all time, has said that it is prudent to have a well-diversified portfolio that is 5 to 10% in gold. So this portfolio has 5% in gold, but again, you can tinker with this. Dalio, I think, has about 6% of his portfolio in gold. Do your research and decide how much gold you want to have, if any. I mean, Buffett doesn't even like owning any gold, but gold is great for hedging yourself in a market crash. Just look at how gold has performed in and after the last market crash. Let's move on, and the next thing I wanted to look at was cash. And when I say cash, I mean cash equivalents like treasury bills and interest-paying bank savings, not just cash tucked under your bed. I've put 10% of this portfolio in cash, but I know Buffett has 30 to 40% of his portfolio in cash. So again, do your research and decide how much cash you want. Cash is great for when stocks crash, and you can buy more stocks at cheaper prices. I will say this, Buffett is looking to spend that cash generally at all times, especially that the market is down in 2018. It means cheaper prices, cheaper deals. Now, don't get me wrong, I think the United States is one of the best, if not the best country to invest in, but I still believe we should diversify our portfolio across countries. What you'll find about a lot of international countries is that the stocks are a lot cheaper than the US because they are less well known and everyone wants to invest in the US. Also, a lot of outside countries are growing faster than the United States, meaning businesses have higher earnings growth. So make sure to diversify across countries, but tinker with the amounts of international stocks that you want in your portfolio. But of course, the United States is the country that we know and trust, and this is why, especially if you're a US citizen, to have most of your portfolio in US equities. Some of the greatest companies come from the United States, and I guess they're the epitome of Western capitalist culture. I've got 65% of your entire portfolio in the US. Having more than that probably wouldn't be a bad idea either. And of course, try to diversify your portfolio across a range of sectors because each sector will perform differently in different stages of the economy. So it's prudent to be diversified through at least a couple of these sectors so that you have stocks that do well no matter what stage of the economic cycle we are in.
And guys, I know there was a lot of information in the video, and I don't expect you to take it all in at once and understand everything. You might want to go back and watch this video again, or you might want to go and watch some other investing YouTubers and build up your knowledge on investing before you take the first step into the stock market. And so I hope you derived a ton of value from this video. Be sure to drop a like if you did, and I know I keep harping on about dropping a like. I probably should shut up about it, but because you guys have been dropping so many likes on my videos lately, so I really do appreciate it all. Anything else I had to mention? Also, if you want to go more in depth into my model portfolio, it's called the Investing Academy, link in the description. Guys, that's it. Make sure to get your money working for you. That's basically what investing is. It's buying businesses so you can sit back and watch your businesses grow. Yes, you do have to do a bit of research, a bit of reading and learning about the stock, but in the long term it's worth it because it's called passive income. Your money grows while you sleep. Easy as that. Guys, I hope you have a good morning, and if I don't see you again, have a good afternoon, good evening, and good night.